Good morning. Hello and welcome to Opening Bell. I'm Surabhi Upadhyay and you're with us on this live on Moneycontrol. Thank you for joining us on YouTube or on the website or on your app, wherever you might be watching us. Well, it's Tuesday and it's a bit of a different Tuesday. There's a bit of a relief that's sweeping across global asset classes, global markets, and it's all because of what President Trump said overnight. He's promising intervention in the Strait of Hormuz. He's saying that this conflict is moving to its through its logical course. That's the oil price that we're talking about. Yesterday, the price of Brent fell as much as up to $83, $84 a barrel. So since then, there's a small recovery. But in general, prices have cooled off big time after those comments were made. So before we do anything else, let's listen in to the US President.
We want to keep it that way. As we continue Operation Epic Fury, we're also focused on keeping energy and oil flowing to the world, and I will not allow a terrorist regime to hold the world hostage and attempt to stop the globe's oil supply. And if Iran does anything to do that, they'll get hit at a much, much harder level. I will take out those targets that were easy and that I mentioned just before. We'll take them out so quickly, they'll never be able to recover, ever. But think of it, we knocked out 46, it actually took 3.5 days. Their terrorist leaders are gone. We're counting down the minutes until they will be gone. Think of it, we had leaders and they're gone. Then we had new leaders and they're gone. And now nobody has any idea who the people are that are going to be the head of the country. And will not relent until the enemy is totally and decisively defeated.
Okay, so that is the US President. Let's get you the headlines. US President Donald Trump says that the US and Israel are close to achieving war objectives and the conflict will be over very soon. Iran threatens to block regional oil exports while Trump threatens to hit the Islamic Republic far harder if it stopped the oil flow through the Strait of Hormuz. Stocks on Wall Street staged a stunning comeback on Monday's trading session as Trump signals an end to the war. Asian markets also open with healthy gains, while the gift Nifty is indicating a gap-up start for our markets. Oil prices sees the biggest intraday reversal after Donald Trump says that the Iran war will end soon. Brent crude prices fall 10% overnight. They trade under $90 a barrel. Gold also extends its losses, slipping to about $5,091 an ounce. However, gold is staging a reversal this morning. India's oil ministry issues an order to deal with LPG supply. Oil refineries have been asked to step up LPG production, and the extra production will be used for domestic use. Restaurants and hotel bodies have warned of severe disruptions as commercial LPG supply lightens. The government has formed a panel to review the representation of LPG supply to restaurants and hotels. AI firm Anthropic has filed a lawsuit to block the Pentagon from placing it on a national security blacklist, escalating the AI lab wars and the high-stakes battle with the US military over usage restrictions on its technology. Okay, so those are the headlines. We've largely woken up to slightly quieter and calmer screens. The question is whether the words and the actions will actually match up. So what did the words say? Like we told you in the headlines and in that soundbite, President Trump is saying that the US is achieving major strides towards completing its military objective. Now, did he give a timeline to when the war will end? No. But he also went on to say that we are focused on keeping energy and oil flowing through the world. That's not all. He was speaking to CBS, the CBS network in the US, and that's what got the market really excited, because that's when he said that the war is, and I quote, very complete, pretty much. And then he was asked whether the US will have a bigger role to play in the Strait of Hormuz and how do you start the passage of ships and vessels through that strait. And he went on to say, and I quote again, the US is thinking about taking over the Strait of Hormuz. So these were the comments. And they are behind the entire market reaction we have seen over the last 12 to 15 hours in overnight markets and this morning in Asia. So now let's look at the stats. The Dow was down 900 points at one point in time. it finally closed with a gain of 0.5%. The S&P 500 was down 1.5% at one point, and then it finally ended up with a gain of about 0.8%. The Nasdaq was up about 1.5% as well. So that was the nature of the volatility yesterday and the swing from the lowest point to the highest point as the market digested those comments. Now, if we talk about what's happened with the oil markets, Brent, as I said, fell to $84 initially when those comments were made. Now it's recovered, and again, the prices are above 90, at least as of Asian trading as of now. But it's still, of course, a much, much better level to be looking at versus 120, which we saw briefly yesterday. The dollar cooled off after those comments. The dollar index is below the 99 handle. US yields cooled off slightly, a couple of basis points here and there as well after those comments. This morning, what we've seen is that there is a bit of a bid on gold and silver prices. They're up between 1% to silver in the morning when I saw was up almost 4-5%. And this would be on the back of a weaker dollar. Now, what's important to note today is that the G7 is having this virtual meeting and they will discuss the prospects of releasing strategic oil reserves so that the market remains well supplied. So that, coupled with whatever President Trump is promising, US taking over the Strait of Hormuz, keeping oil flowing, all of that has led to some of that risk premium coming off. However, the real issues remain. Until the Strait opens, oil cannot move. And yesterday, Saudi Arabia got added to that list of nations which have started shutting down their oil production. So Kuwait has done it, Iraq has done it, Bahrain has done it, Saudi Arabia also is no longer now producing at the same pace as before. Let's talk about our market. Of course, we're going to get this gap up start. That's what the GIFT Nifty has been indicating. It could be a 250 point to 300 point gap up. So we need to watch out for that. The question is, what happens after the gap up? Can the bulls hold those higher levels above 24,000? Expect a relief on the rupee as well. Yesterday, the record closing low was 92.33. So because the dollar is on the back foot, generally risk assets are doing better this morning. Expect the rupee to show some strength as well. However, the fundamental issues remain. FIIs have been constant sellers throughout this conflict, throughout the month of March. Yesterday, they sold off cash stocks worth about 6,300 crores. Domestic institutions were, of course, buyers. Bought lots of stocks yesterday, about 9,000 crores of DII buying. But FPI selling has come back in March, and that's something that we have to watch carefully. So where does this leave our market? How should you be looking at your trades and your investments right now in this extremely volatile world? Well, we have both our experts joining in. We have Dharmesh Kant, who's head of research at Cholamandalam Securities, is joining us with a fundamental viewpoint on all of this. And Shrikant Chauhan, head of equity research at Kotak Securities, who looks at technicals very, very carefully. He's joining in. Good morning, Shrikant and Dharmesh. Great to have both of you in. It's these days one gets very little sleep. I'll admit, at least for myself, because every hour there is a new statement, every hour there is a new post, and you have to look at it because markets will react to it, right? So let's get your first sense on everything that's happened in the last 24 hours. Dharmesh?
Yeah, good morning, Shobhi. Good morning, Srikant, and to all of yours. Yeah, it's a relief coming down. It may be temporary because knowing Trump, a missile here and there can again re-trigger the escalation of the conflict, and the fact that he wants to have the control over the Strait of Hormuz is a bit scary. Because see, if you study Trump, what he has been doing. First, it was Latin America, where he has captured already Venezuela. Then he has an eye on Cuba and Mexico, and then Greenland. And here, Iraq was already being, captured in a way by US, and now they are attacking Iran and the entire Middle East. They want to control. So it's more of a business-like trade, which US wants to control and dictate the terms. Tariff, not to forget. Tariff is again the same step in that order to dictate the terms how the world trades, and it should be in favor of US market. So that's the underlying fact, and it will keep on coming. This is Iran is today, maybe a couple of months later, something else will come up, and that would be the order of the market. In this volatility, we have to negotiate the market, and there I think for this year itself, entire 26, I am looking at is from the point of view of domestic inward-looking economy. And the sectors you have to focus out there. So declines are definitely to be bought into, but what you are buying will, be the differentiator between whether you are able to make money or not. And there, I think the sectors are very clear. Defense remains completely insulated from whatever is happening. In fact, it's beneficial for the defense sector, so that tends to gain more from it. Followed by maybe, metal pack, where I think the aggression will still continue. To volatility is there, but metals are definitely, because of the infra push out there, it will continue to seek a higher traction. Automobiles, auto ancillary, and banking and financials. So these are the broad sectors where action will be there. Financials, we are not a bit, I mean, NBFC space, we are a bit skeptical at this moment. But banks, particularly private sector and public sector banks, on declines are a good betting opportunity. So these are the sectors where we are focusing on from investment perspective. Trading perspective, I think it's time to look at, consumer durables like LG Electronics, Voltas, and Blue Stars of the world, because summer is coming quite faster and harsher this time around. Predictions are it will be a better summer this time. Last entire year was lost to because of the weaker summer and erratic monsoon. I think it's time to look at those companies from a trading perspective. Valuations are very attractive for LG Electronics. So this is how Survi we are approaching this market. But having said that, be prepared to see any day a big
Sure.
rate coming on the screen.
Well, yeah, I think you put the caveat out. That's the disclosure, right? That things can turn on a dime. We are in that kind of a market. We have that kind of leadership. So no taking away. So, Dharmesh has already given us one buy idea that he thinks fundamentally makes sense. That's LG Electronics. I'll come back to some of the others in a bit, Dharmesh. Shrikant, good morning. This market has had so much thrown at it, right? From AI worries to IT stocks crashing to budget. And now here we are. The Nifty is fighting for life around 24,000. We have a bit of this interim relief rally. The war is not over. President Trump says it will get over eventually. But Shrikant, what have you made of the price damage? And what would the advice be to the shorter term traders first?
Good morning, Survi. Good morning, Dharmesh and everyone. So for Nifty, it has broken crucial important support level at 24,300. Above this level, the market has spent almost 8-9 months. And breaching this level clearly indicates that we can expect further more weakness in the market or some more consolidation at the downside or maybe lower boundary of the entire range of the market. And whenever we see dip sell off, we see some rebound, we see some dead cat bounce. And today is the best example of the same. I am of the view that 24,200, 24,300 going to act as now major resistance for the market. And in case if we see the market is opening somewhere close to those levels, then there we should look for reducing some leverage long positions instead of adding any long positions, because the market is going to take some more time to form specific bottom in this market. Broadly, we are of the view that, and we are recommending our clients to look for adding BFSI stocks to their portfolio, because see, right now FIs are heavily selling into the market and they sell all these large cap companies, or we can say A grade companies towards the end. I'm going to say when they don't have any other option to sell in the market, that time they start looking for reducing exposure from the good quality companies. And that time it gives an opportunity for investors to invest with a medium to long term view. So I think HDFC Bank, State Bank of India kind of stocks have fallen to their extreme levels and we should look for buying them. If we again see the market is dropping to 23,800, 23,700 in the near term, in case market breaks 23,500, then the next possibility of 23,000. But I am of the view that 23,500 and 23,000 is going to act as strong support for the market. And there certainly we should look for taking some long bets in the market.
But for now, if we get this bounce, and the GIFT Nifty was indicating exactly that we'll probably open around that zone that you mentioned, Shrikant, 24,300, somewhere around that. So at that level, the Nifty, for short-term traders, the Nifty becomes a short again?
Yeah, absolutely. Because the way 24,300 supported to the market in last 8-9 months, I'm very clear that this particular level is going to act as stiff resistance. And it will be an opportunity for, in fact, short-term traders to look for creating some short positions between 24,200 and 24,300. We can keep a stop loss at 24,400 because if finally this market is completely depending upon the news flow. So in case if something comes positive and market breaks the level, then we need somewhere some protection. So 24,400 should be the final stop loss for creating a short position.
Got it. By the way, that's, the GIFT Nifty, I think that we'll just refresh that rate. It is indicating that we will start on the positive side today. So we should take that off. The Nikkei, some of the Asian markets are really rallying. So the Nikkei is up about 3%. The Hong Kong market is up about 1.2%. Shanghai is up quite a bit as well. And the South Korean Kospi was up quite dramatically last I checked. I'm just checking where the Kospi is right now. There's a 5% rally on the Kospi. So that's the way Asian markets are shaping up. And we'll probably rise in tandem. The question is what happens afterwards. Now, I want to talk about financials with both of you gentlemen, and that's what I think a lot of our viewers have queries on as well. And viewers, morning to everybody who's joining us right now on YouTube. We'll be taking your questions very, very soon. Dharmesh, you said that you have some issues with NBFC stocks, but you'll be selectively positive on certain banks, some financials. So just elaborate, because in the last two trading sessions, banks, PSU banks, the bank Nifty, it got hit so hard. I mean, it was the worst performing part of the market.
Yes, so I mean, last 2, 3 trading sessions, one should be looking at from a profit-taking point of view rather than fundamentally something changing on the banking front. So it was because there was people who wanted to take money off the table because of uncertainty prevailing in the market, and banks were the ones where you were making actually good money. So that was taken off. I think that selling should be over by now. So from here on, it should be more of a fundamental driven kind of scenario for banking space. Why I'm worried about NBFC is there's a bit of a slowdown into the tier 2 and 3 levels of the lending space. So we have been seeing some stress out there. The business growth is not coming as desired in 15-20% kind of a move. At the same time, this situation again leads to some, a hardship in the MSME textile. And there are many, I mean, directly, indirectly, many sectors are affected by what is happening in the Middle East. So those will again be an worry for the NBFC space. The government will do its bid by extending the corporate credit, and they will supply the credit line. But for the timing, it will slow down the business. So many of the businesses are now, we have been talking to business owners, they said, yeah, the supply is ready at our end, but माल उठना तो चाहिए. So if it's not being able to be shipped by 31st of March, so it won't be booked. So that's the problem out there. Second point on the NBFC space is the cost of funds are likely to firm up from here on. First is there won't be any interest rate cut at least for next 6 months because of the firming inflation. At the same time, the market level lending, I mean the borrowing for NBFCs will become more firmer, and I think 12 to 15 basis point would be immediate impact in this quarter itself on the cost of funds. So these are the two caveats, and they were already commanding a higher valuation multiple. So it's more of a sell and rally for me for the NBFC space.
Okay, so cautious on NBFCs, but positive on some of the banks. Srikanth, what did you make of the selling? And it was on Friday as well. Bank stocks were getting pummeled yesterday. Of course, there was some recovery, then even banks recovered. But at one point, the Bank Nifty was down 4%. PSU Banking Index 5%. And now I'm asking both for traders and for investors. A lot of investors want to get into bank stocks using the present dip, the present volatility to buy in. So advise both sets of people. Traders on what they should be doing with banks and the Bank Nifty, say, and investors who want to invest now in some quality bank names. Which would you go with? I mean, which are the ones that are looking strongest, at least technically?
No, I think, see, Bank Nifty has fallen, we can say, in the end. Before that, we saw good amount of sell-off in almost all the indices. But when the market has really started feeling the hit of the war and all, that time we saw selling in all these good companies. We are of the view that all these banks have now fallen. I mean to say, yesterday when there was fall in the market, they have corrected to their extreme support levels, and investors should certainly look for adding large cap banks to their portfolio. State Bank of India, which was around 1200, is currently at 1080, 1070. So it's an opportunity for adding at current levels. We also like ICICI Bank, HDFC Bank, but yes, we are asking them to add in staggered manner because market is still under a lot of worries, and means there is, and see, like we cannot get always any major clarity in any type of scenario of the market. So ideal strategy should be to look for adding at current levels, more on dips, and we also like a few PSU banks to trade for. So in case if we see any rebound in the market, if the market starts forming any double bottom, triple bottom sort of formation, then there we should look for taking some trading bets in bank stocks. But for trading, for short-term traders, our advice is to stay away for the time being, because in case market remains weak, then we can expect further more weakness in these stocks only, because there the investors have a lot of stake. So we can expect some more weakness in the short term, and that's why for traders, just stay away. For investors, certainly they should look for adding at current levels.
Okay, all right, got that. So that's the advice on bank stocks, and make sure what you're sure of what you're doing. Are you trading in and out of these stocks, or are you selecting them for your portfolio for medium to long-term wealth creation, and then decide your strategies accordingly? Okay, gentlemen, just give me 2-3 minutes. There are a couple of interesting stocks in news as well. There are lots of F&O additions, by the way, that the exchange announced yesterday. So let me quickly run through today's stock radar, the stocks that we should keep on our list. So here's what we're looking at. NSE has announced the inclusion of 6 new stocks in the futures and options segment, and this will happen from the 1st of April. So which are these stocks? Adani Power, Cochin Shipyard, Hyundai, Motilal Oswal Financial Services, Nippon Life, and Vishal Megamart. These 6 stocks get added to F&O. So expect more trading excitement around them, and we'll see how they open out. Typically stocks flip up positively in a normal market whenever they are going to be added to F&O. It tends to increase volumes, tends to increase the trading participation as well. So keep them on your radar. Dixon Technologies, it has received the approval from MeitY for HKC's 26% investment in the display unit. So that's a big shot in the arm for Dixon's moves forward with that part of its business, the display business that they're building up. Now they've got the requisite approval as well. So keep it on our radar as well. Reliance, Reuters yesterday reported that Reliance has bought 6 million barrels of Russian oil. So at least some of those Russian barrels, those Russian Urals have started flowing back towards India. Good news for overall, of course, for our macros as well, and Reliance is on our radar. Now, speaking of oil and gas, a lot of the QSR stocks and names like Eternal and Swiggy, I will keep them on my radar for sure. And why is that? Because yesterday, the Restaurant Association of India actually came out and said that the food sector could be facing a severe shortage of commercial LPG, and this could cause a lot of disruption. They are saying that existing LPG supplies may last only 1 week, and this shortage is raising risks of a widespread restaurant shutdown. So obviously, all of the companies, the QSRs directly, your Westlife, Sapphire, etc., and then of course Swiggy and Zomato, we'll keep all the stocks on our watch list today. Let's move on. ABB India is looking to invest about $76 million in its India business in the current year, 2026. The investment is aimed at expanding its manufacturing capabilities, and also they are looking to boost their R&D. They'll be looking at critical infrastructure sectors, including renewables and metro rail. Those are the 2 sectors that ABB has specifically called out. ABB came out with great numbers as of the last quarter. Remember, the stock rallied quite nicely. So let's see what it does in trade today. IRFC is looking to raise about 70,000 crore rupees to meet its financing costs. This is obviously debt financing that they are raising. And it is going to be done via the domestic and the offshore market. So mix of Indian money and foreign money going the debt route. Lemon Tree has set up another property in Uttar Pradesh. It signed up a property in Gorakhpur, and now its total hotel count in UP goes up to 26. So more expansion in Uttar Pradesh coming through. All right, with that, let's get back to our experts. We're also getting quite a few viewer queries, by the way, at this point in time. For instance, there's a viewer who's James, who's saying that kindly update me on ONGC. I've been holding it for 1 year. I'm in profit. Should I accumulate more for the long term or exit? That's a great question, James, and I completely understand where you're coming from. Now, Dharmesh, let me use this to ask you a wider question on oil and gas. Definitely advise James on ONGC. Now, people who are sitting on big gains on Oil India, on ONGC, what should they be doing? Is this the time to exit, book that profit? Or do you think there is a longer term structural sort of reason that perhaps will make these stocks see higher levels?
So I'm in the camp where there's a longer term structural reason to exit these companies and book profit out there, because oil and gas consumption has been stuck at 104 to 105 million barrels per day worldwide. And because of renewable energy and adoption of electric vehicles and the other forms of renewable energy vehicles into the system, hydrogen is still in the offing. Buses have been tried about if that clicks. So that would be the biggest disruptor for renewable energy segment. So we are of the view that eventually this consumption will go down going forward, and that was what was reflected in the Brent crude prices, $60 a barrel before this war disruption happened. So these news flows are an opportunity for people who are stuck into the system to get out of and book profit or even book losses and be out, because there are multiple opportunities in the other sectors. Upstream companies, I don't see them structurally benefiting in the years to come. So it's a complete exit from us, just because it's been replaced by renewable energies.
Okay, so you're structurally negative, saying that this is probably this pop, this bounce that we've seen is a good opportunity to get out. James, there you have it. That's the fundamental view. Shrikant, technically, these stocks have been the most volatile. By the way, the pre-open session has started. Let me just quickly see what the Nifty is doing right now. At the start, the Nifty is up about 360 points. We'll see how it plays out. And there is a bit of a relief on most of these stocks, as you would imagine, the ones that we're just discussing, the oil and gas space. So that's the Nifty in the pre-open, 350 odd points. And look at IOC, HPCL, BPCL, all the downstream companies. Stocks are up about 2 to 4%. MRPL is up about 1%. ONGC right now is flat, about 0.5% lower is what we, 0.5% higher on ONGC. That's what we have. So no major moves. I think the Indian market is being very measured in its response, at least at the stock level. Index will allow it to settle down. The Nifty is now showing 260 points. That's sort of a gap up. So let's give it a couple of minutes, and then we'll come to the final the rates. Interglobe Aviation is spiking higher because the expectation is that obviously if crude at least cools off back down to 90 around, it will take off some of the sting. L&T is seeing a relief rally, 3.5% higher. The stocks are on your screen, they'll keep flashing, but let me go back to my experts now. Shrikant, this entire set of stocks, which was reacting so sharply to what was happening to oil, including names like L&T, including Oil India, ONGC, the oil marketing companies were absolutely pummeled. They've fallen, what I think, 7, 8, 9, 10% in the last couple of days. What's the trading advice on the whole pack? And we can go, sector by sector, stock by stock.
So let's say at these levels, the way we saw rally in ONGC on the back of crude prices, we are of the view that we should look for reducing some exposure if there is like a good amount of profit that we are making, because I am of the view that whenever there is a rally in the crude prices, especially over and above rally, we see buying interest in ONGC. Otherwise, ONGC remains in a range. And I think it's an opportunity for investors to take some profit at this level. I'm not expecting this stock to perform or to sustain above the levels of 300 for a longer time. And especially after this particular episode, one thing is very clear that all these users, they will start looking for some alternative energy. So broadly, I am of the view that it's an opportunity for reducing some exposure. For other refining companies, there also we are of the view that they are currently still expensive, and in case if there is any specific view, then we should look for adding them with a view of making dividend income out of this company. So in that space, with that view, we should look for adding IOC as well as BPCL to our portfolio. But otherwise, it is better to stay away from taking any exposure at these levels. We like Reliance Industries from this energy pack. There we can expect further more gains. The business is overall diversified, and after this particular episode, now GRM margins will also support the Reliance industry to do well in the near term. So Reliance should be the stock to watch on the list. We also like Indigo. The stock has fallen vertically from the highs. There are multiple negative reasons, news flow for the company, because of which we saw deep decline in the stock. But I think between this 4,500 and 4,200, we should be buyer with a long-term view. I think this stock is now very close to its long-term support areas, and from here we can expect gradual recovery or rally towards the levels of 5,000. So Indigo and Reliance, these are the two stocks to buy for.
Okay, got it. By the way, while we're talking oil and gas, I think the stock of the morning may just be Dixon. I want to point that out. Let's pull up Dixon Technologies. Stock in the pre-open is surging 6-7%. And that's because of that approval that the company has received from MeitY, which is the Ministry of Information Technology and Electronics. And this is the approval to get HKC, one of the HKC subsidiaries, to invest in that display unit that they're building together. 26% is going to be held by HKC. I think about 74% is going to be held by Dixon. And together they'll move a step forward in LCDs and other higher end displays, which go in laptops, mobiles, so on and so forth. And that seems to be getting the market fairly excited, 6.5% higher. Is Dixon under your coverage? Just quickly checking that, Dharmesh.
Yeah, it was under our coverage.
Dharmesh,
And
that
then
was
we
for you.
dropped
Yeah.
it out.
Yeah.
And right now we are just, yeah. So, yes, yeah, so it was under our coverage earlier, but we, dropped it out around a year back from the coverages because of the developers out there. But I think fundamentally the only concern out there is the valuation part. So valuation justification will be hard to do. But structurally, the business looks pretty attractive, and we are again reassessing when to reinitiate it for a buy perspective. Because all the developments which is happening now in the company and the interaction suggests that value addition will be more out there, which will be margin accretive. More parts will be, manufactured in India rather than getting assembled in India. So, but that's the transition which is happening out there. But eventually, so our sense is the entire EMS space will 35 to 40, and they would be registering a growth of 20-25%. So, but that's the radar. Still, they are way ahead of 1 year
Sure.
forward P/E. That's the reason why we are not actively suggesting that. Buying trades based on technicals keep on coming.
Okay, got that. Well, the pre-open is suggesting a nice 1% kind of a gain for the indices now as it's settling down 240 points on the Nifty. Sensex is up about 1% as well. And it's a broad-based relief rally. That's what we've got. So, a lot of consumer stocks, obviously crude sensitives like Interglobe Aviation, most of them are up and about. L&T, which has been battered so badly, that's up. Most parts of the Nifty, almost everything is higher. So final thoughts, gentlemen, now, before we let you go and kickstart your day. Shrikant, your top trades today, your final trading advice, because this is still a confusing market, right? It's a market that's moving on headlines that are coming by the hour. So your overall advice, your top trades, maybe even a word on Dixon, in case you like that stock. It's above 10,000 again with this pop today.
Yeah. So for traders, our advice is to stay away from taking any specific view on index because index is going to remain highly volatile and in a very broad range. In fact, this is an opportunity for leverage traders to reduce some long positions close to this 24,200 at opening. And in case if there is any rebound up to 24,300, 400 levels. So between these levels, we should look for reducing some positions. For Dixon, we are of the view that it is going to remain volatile. At the same time, the stock is still forming lower top, lower bottom series. So there is no clarity that what can happen in the stock. And that's the reason I am of the view that we should stay away from taking any short-term view. If there is a long-term view, then I think the stock has corrected sharply and heavily from its high. So we can always expect rebound towards the levels of 11,000, 11,200, but it will take time. So if there is a medium to long-term view, then look for adding Dixon technology even at current levels. But for short-term traders, just stay away. And for taking any specific trade, I think Reliance still looks good. If there is any furthermore legs in the market, then Reliance can move towards the levels of 1450 and we can keep a stop loss around 1390 for the same.
Okay. All right, Shrikant, thank you very much. Very, very helpful advice. And we wish you a very good day. Hopefully the bulls will manage to have some sigh of relief today. A little green color will be visible through the bulk of the session at least. Thanks for joining in. Thank you.
Thank you.
Yeah. Dharmesh, now coming to you finally, you gave us some ideas. You already mentioned LG Electronics, and this is that part of the conversation where we talk about the compounding idea. Markets can be up, down, volatile, couple of days here and there. But again, these are specifically ideas for someone who's looking to pick up a portfolio stock. And this is a good market, right? It's fallen so much. So give us one or two more names, stocks that you like and why.
So, I mean, as a portfolio stocks, we like the defense sector. I mean, the order inflows has been flowing in, and there I think for a compounding idea, two stocks apart from LG Electronics, which we have spoken about. One is HL, Hindustan Aeronautics. We continue to like, despite being there were divergence about this execution capability. I think the execution capability is there. There were some structural issues and some bottlenecks. The engine supply is not been coming there, and that was the reason for the delay in LCA. Tejas aircraft manufactured. So that's being put into place and of their revenue potential. So this is likely to play in big time for their in a environment of uncertainty. At least you have a certainty of profits trickling down there. The other company from the booked our profits out there because of the target price being achieved, and then the company went into a sort of a slowdown phase for a year, is likely to be back into action, and that is DCX Technologies from the same DCX systems from the same defense space. So order book is now in excess of 2,700 crores. Recently, they have won an order book from HL around 68 crores. So an execution is likely to pick up from this quarter Q4 and Q1 of FY27 onwards. They were spending on one of the subsidiaries, so that spending is over, and that ODS object detection system from the railway, just for railway object detection system, its production and orders inflow is expected out there. I think it's a bombed out stock. Good to look at this. High stock prices, it can be a double in next 2 year time frame.
Okay, all right. So plenty of ideas there from the defense space, and of course LG Electronics was the earlier pick that you gave us. Thank you very much. A very, very helpful conversation, and I think these ideas will work well for people who want to use the current volatility and the dip to build their long-term portfolios. Dharmesh, great conversation. Have a fantastic day, and we'll connect again soon.
Thank you so much.
Thank you. Thank you. Okay, well, before we introduce our next guest on the show, let's take a look at the pre-open, which is now fully settled. It's about a 1% increase. That's the extent of relief that the Nifty is indicating right now. The bank Nifty is also looking like it's all set for a 1% gap up. That's what we have, at least for the time being, 56,583 on the bank Nifty, and there's a Nifty for you closer to the 24,300 mark, which a lot of technical analysts say is a big resistance. So we need to see how the bulls navigate that zone. All right, with that, let's move on and welcome in our next guest. Arvind Chari, Chief Investment Strategist at Q India UK, is joining in. Arvind, good morning. Great to have you on the show. Thanks so much for taking out the time and being with us on Moneycontrol. Difficult markets, confusing markets, volatile markets. What have you been doing, first of all, in this period of extreme volatility and unprecedented disruption, with crude surging the way it did, and now it's reacting to headlines and it's come down 20% overnight? What have you done through all of this in terms of your investment bets, just the way you've managed the portfolio?
Survey, it's good to always speak to you. So thanks for having me on your show. I'll just give a little bit of perspective on how to approach these things, and then I can talk about what we are doing specifically in the portfolio. Like when clients ask us what are the risks that you think about India, and we always say that in the short term it's oil prices, and in the long term it's job creation, because job creation has a social impact. And oil, as we know, because we import 80% of our oil and gas and even a lot of fertilizer, that tends to be a significant impact, right? But if you've seen in the last decade, it has not mattered, right? Oil prices have actually traded well below $80 a barrel. And over a period of time, if you look at the way the economy has evolved, I think India's threshold for oil prices has increased. Maybe it was about $60 to $80 a decade or 15 years back. And now, because software services are larger, remittances have picked up quite dramatically. The other export opportunities have picked up, and some amount of dependence on imports has reduced. Maybe the threshold for how we can bear oil prices is a lot higher today. But if you look at the history, but in that period between 2010 and 2014, that was a time when oil was actually well above $100 a barrel. And of course, there was demand and supply issue, but it was also triggered by a lot of Middle East conflict, Arab Spring, ISIS, Islamic State being, disrupting oil prices. And you saw that oil was trading well above $100. And of course, that was a time when India was also fragile right? The current account deficit had gone to about 5% of GDP, and you had a significant impact on macro, especially on the currency and interest rate. So that's the thing. That's where we are coming from, and maybe the reason the markets are reacting.
Yeah, Arvind, I'm so sorry I'm interrupting. It's just that the market is open, so allow me 2 minutes to go through the quick initial rates, and then we'll come back to the strategy that should be adopted in this market. So we've got that gap up. It's a 1% gap up as what the pre-open session was indicating. The Nifty at 24,217, 16. It's kind of trying to find its stability around that zone. Mid-caps are doing better. The mid-cap index is up 1.5%. You can see the advance decline ratio is looking very, very healthy this morning for a change. On the National Stock Exchange, you have well over 1,700 stocks opening on the positive side of the screen, just about 170 stocks on the declining side. The bank index is up about 1%, the bank Nifty that is. Mid-cap, like I said, is doing a little better. Let's come down to individual stocks and give you the Nifty gainers now. Interglobe Aviation, Asian Paints, Shriram Finance, Tata Steel, L&T, it's everything. It's one of those sweeping moments. I mean, yesterday was a sweeping red wave. This morning, we've got a sweeping green wave. That's the power of some of these geopolitical moves that we've seen. So it's a long list of winners. Tata Motors, Eicher Motors, Titan, Geofinance, M&M, Maruti. Actually, a lot of auto stocks are up. Auto got hammered very badly yesterday. So there's a big relief on a lot of these stocks. So many of the Nifty gainers are auto names. What else? ICICI Bank, SBI, Geofinance, Kotak Mahindra Bank. So a lot of these financials, banks and NBFCs, all opening with smart gains. Shriram Finance is leading the charts, 2.5% up on this stock. Let's see what Reliance is doing. Reliance is also now, getting its hands on Russian oil. Reliance is open slightly lower, down about 1%. ONGC is down 1% as well because obviously, oil has cooled off. So that's having its sentimental impact. 1.2% down on ONGC. Coal India and Cipla are some of the other names that are down. That's Reliance. Stock in focus today with all the oil and gas developments that we're seeing around. And that is ONGC. I'm quickly moving to some of the stocks and news. We should pull up Dixon to begin with. Dixon Technologies, which has received METI's approval to get that participation going with HKC for its display unit. That's working very well for Dixon. It's up 6%, 10,400 almost. Not that's the news, but let's get the stock on the screen. Dixon has opened up 6% because of that news that's on your screen. What else do we have? Then we have a lot of gainers from the oil and gas space. Petronet, LNG, HPCL, IGL, all of these stocks are up and about. For the time being, that's Dixon. For the time being, a lot of the QSR stocks and even names like Swiggy and Zomato, for the time being, they're all holding fine. Yesterday evening, there was so much of nervousness about gas supplies here in India. And the Restaurant Association had raised the red flag saying that there's just not enough supply of commercial LPG. So this is going to disrupt restaurant operations. And there was a worry whether that spills over to the platform companies like Swiggy and Eternal. You can see right now the stocks are holding up just because we've got this overall positivity in the market, some sense of relief after what Mr. Donald Trump has said. So most of these names, HPCL, IOC, IGL, Mahanagar Gas, all the entire oil and gas complex has opened out in positive territory, at least for now, for what it's worth. So let's do one thing. Let's keep flashing some of the other gainers for you as well, the mid-cap gainers. Hitachi Energy, for instance, is up about 4%. Escorts, Kubota, Minda Corporation, lots and lots of mid-cap stocks. It's a pretty vibrant mid-cap screen. Mid-caps are anyway doing better than the large caps this morning as we see the first trades coming through. Mid-cap index up 1.3%. The Nifty, by the way, is up just about 0.5%. And that was always the challenge. We get the pop, that we will. But will people sell into that gap up? Or whether the bulls will build on it. Right now, it seems that the cautiousness is very, very visible and evident on the screen. Okay, so let's get back to our conversation with Arvind Chari. Arvind, so that's the question. Now, we know the backdrop. It is what it is. It is volatile. We have no idea to know. I mean, no way of predicting what the US will do tomorrow or where the missiles will fly. In this context, what should the portfolio positioning be? How much of, would you still go all in on Indian equities, or is this the time to take some risk off the table? And within the Indian equity basket, what would be your biggest bets?
Yeah, so the way to approach this is it depends on the expectations, right? If you build and expect your portfolio because based on the fact that the real GDP growth will about 6.5%, you'll get, slightly 10-11% nominal GDP. In that framework, we have seen Indian markets, Indian earnings do not disappoint. And that's why, most of the risks and challenges that India faces, there is always, some way out if your expectations is reasonable. But when you expect a higher growth or, some themes to play or some growth to pick up, and then you're paying top dollar valuations to be able to play those themes and ideas and stories, that's when everything has to go right? So in a scenario like that, when oil moves from $60-$80 to say $100 an average and stays there, the point that we would have to make it is that this short-term spikes are okay, but if this remains like this for the next 2-3 months, then that's when you will start feeling the impact. In that scenario, some of the companies and some of the sectors and some of the valuations will definitely get challenged. But if you have a reasonable expectation to begin with, and then you build your portfolio along with that in terms of reasonable valuation expectation, then I don't think generally you don't tend to get disappointed. Of course, you'll get volatility. Of course, you'll get drawdowns in the markets, and maybe some of those drawdowns would become opportunities. The way we have seen it is September 2024 is when we, purely based on the upside potential that we saw in our own portfolio and the valuations where the portfolio was trading, we became a bit cautious. We were guiding clients to maybe take some capital back, or if they're allocating new capital, give us less than what they intend to invest in India. Uh, Sometime late last year, we kind of increased that as earnings momentum has picked up, and we could see the cyclical recovery in earnings. We could see cyclical recovery in the business. Valuations had become a bit more sane, although the indices do not show it. But at the stock level, that there has been reasonable drift down on many stocks. So based on that and how we were building our portfolio and allocating, we got a bit optimistic, and we were again guiding clients that India has had a significant underperformance to emerging markets. Rupee also has depreciated, and the entry points are better. And we think, as we've always said, foreign investors are underallocated, and because of the underperformance, the underallocation has increased. We should see foreign investors coming back, and they should start looking at allocating more capital to India. So from that perspective, this Middle East conflict has not come at the right time, because if you see all the last year, the India-Pakistan skirmish, then the strange tiff that we had with the US, and now this. So sentiments maybe are not as attractive. Valuations are definitely getting attractive, but we'll have to see the macro impact, because as I said, 80% we are dependent on oil and gas and fertilizer, and coming through that, the Strait of Hormuz, and if it gets blocked for 3 months, and then that will be a challenge. Otherwise, I think things are better. Also, the fact that the markets have not reacted much is also because,
Arvind. Arvind, I mean, that's exactly what I was thinking actually last evening, just out loud in my own head, that this has become a bit of a perfect storm for India. You had anyway weak earnings, and then we were hoping that this is a bottom for earnings and there's a turnaround. And then you have the whole AI situation where India doesn't offer an AI play, unlike other markets like South Korea. And now you have India's very close correlation with oil and gas and what's going on in West Asia. So I'm guessing it becomes that much harder to convince foreign investors to put in the money. So realistically speaking, I mean, will we continue to see a lot of FPI selling in the months ahead as well? And in any case, I mean, what could be the most convincing argument? What could they come and buy here? Will it continue to be financials? That whole idea that India's domestic stories offer a lot of resilience, that idea is getting challenged if oil remains around 90-100, right?
Correct. That is true. And so one other aspect that we were saying that India should be positive is because of that AI, right? India was not AI, so it did not play the theme that AI played in 24-25. So money moved out of India to China, Korea, Taiwan. But if you have to worry about AI bubble, then India is actually a very good diversifier. So even that was another positive aspect going towards India. In terms of foreign portfolios selling, given that they're actually net sold, if I look at 2018, that's when we had capital gains tax, right? That's been a big challenge to attract more capital into India. Since then, foreign investors have only invested about $22-23 billion on a net basis in India. It's like 7 years, and that's a small amount for a $4 trillion market cap economy. So, and as I said, in India's weight in emerging market indices has also gone down. We peaked at about 22%. We are at now, I think, 14 or 15%, and looks like, because of the fact that 80% of the money that comes from foreigners to India is through global emerging market allocations, and it seems like they're underweight. So all those pointers are actually positive towards getting more flows. And as I said, valuations have become a bit saner, not across, but in the large cap space and some mid cap, small cap space, we are seeing that. But you're right, this could not have happened at a worse time. I think we were getting set for flows to come in, cyclical recovery to take place, and now we have this scenario building, which we'll have to say that if oil is at $90-100, which segment gets impacted, because the second order impacts of oil in India is very significant. Although retail prices should not move
Yeah.
much, we didn't get a benefit when the prices were low. So I think the buffer with the OMCs and the upstream oil companies and with the government is reasonably high. But you're right. I mean, this is kind of a bad timing in some sense. And India should hope that Trump claims a fake victory
Sure.
and call the war, and that, so it doesn't matter what happens, but that will be the for India to come about, and then we can go back to the story of cyclical earnings recovery and underinvestment in India, and hope to get
Just
some
when we
foreign-
thought, Arvind, just when we thought that, okay, chalo, trade deal is also sorted, we have a deal. By the way, that's the other uncertainty. Whether the tariff is
Right.
18% or it's going to be now 15% and it's gone back to the US courts and there's litigation there, there's no
Right.
end to uncertainty. But just to wrap this up, what's the bottom line for investors here in India, domestic investors who are watching you?
Yeah.
Because you speak very closely with all these, foreign money managers and foreign investors. This year, we will see more FII selling, less FII selling, gradually reducing FII selling, or constant FII selling. What's the bottom line before we let you go?
My pet peeve, as you know, I've been writing and saying about that, how underallocated foreign investors are. From my conversations, especially with some large investors, although they are not close to allocating, but I think the decision has moved in the sense that they're thinking about the fact that should they have what we call dedicated allocations to India and not play India through emerging markets. If the uncertainty reduces, maybe you will see some of that being kicked in. There are two challenges: capital gains tax, and I wrote about the fact that the government should really think about scrapping capital gains tax for foreign investors, because they get double taxed. They don't get a set off in their domestic market, and so they're essentially getting double taxed, and they
Sure,
really need to look
sure.
at it. No OECD country has capital gains tax on foreign investors, right? So that is one aspect, and the second remains
Sure.
valuation, given the money power of domestic retail. Some of the allocations find
Yeah.
financials be attractive. We find IT service. We've been net buying into IT services, given the fact that we still think enterprise AI will be deployed by Indian IT services firms. I mean, it's not all hell and gloom. They need to rework and
Okay.
remodel.
Okay.
But I think the
Okay.
scope of opportunity actually expand for them. But we'll see. I think if this settles down, expect foreign flows to come in, given the fact that we've underperformed. Last year was the largest underperformance, I think, 25 years, right? So
Yeah.
from that
Yeah,
perspective,
absolutely. So, at least from an entry point, I guess India is offering a good entry point. But a lot of these,
better than
global
last
issues
year.
have to settle. Got that? Yeah. We seem to be better positioned than last year. Got it. Thank you. Thank you so much for joining in. Good conversation. And we hope to remain connected, Arvind. Have a good day. Thanks very
Sure.
much. Thank you.
For having me. Great talking to you.
Okay. Thanks very much. Okay, so that's a perspective coming in on how FPIs are thinking about this market, if they're thinking at all. But now we have, a very well-known local voice joining us, Ajay Srivastava, CEO of Dimensions Corporate Finances, with us. Ajay, good morning.
Good
I don't even
morning.
know where to start. Every time we speak, I ask you about a new problem for the market. Last time we were talking about this whole AI. AI seems to be ending the Indian market. Sometimes it's a trade deal ending the Indian market. Now it's a full-blown war. What have you made of everything that's happened in the last 6-7 days since the war started? And the way the markets
We
reacted to it?
all that are made is what is profit is in the bank, rest all is paper. I think this has come true with such vengeance this year, as people I'm sure understand what I'm saying, is that what they thought was huge amount of profits on the portfolio, vanished, gone. I think the moral of the story this year is, and a simple straightforward, that when you think you got a good profits, you need to take it out, use it to spend it on yourself or others if you feel so, and not wait till goddamn what's going to happen. You're getting older, you will not be able to make that profit again, or maybe it takes some time. So I think the moral of the story is very simple. When the time is good, you book your
But-
profits, take it into cash, enjoy yourself. That's the moral. Simple, straightforward.
But Ajay, who had the profit to begin with? यहाँ तो पिछला 18 months I think have passed where people are waiting for some profits in their portfolio. There is no profit, so what to book anyway? On a lighter note.
So you miss out the fact that I think the biggest game for the last 24 months has been the commodities and metal play. A lot of investors have booked profits, so have we.
That's
Everybody
true.
has sitting on huge profits. So it's, we focus too much on equity. We don't
That's
focus
true.
enough on precious metal. And I keep arguing with the fact that the whole logic of 5% portfolio of precious metal is all bunkum. It's all bunkum, absolutely. We have been saying one third, one third, one third. And I think that theme plays out well. One third overseas, one third precious metal, one third Indian equities. And that's also because I'm highly patriotic Indians. We're stayed back in India. So therefore, I will put my one third money in India, whatever happens. And it's not been so bad compared to what select stocks have been good. If you look at the capital market stocks, they have been done quite wonderfully. AMC stocks have performed quite well. The auto companies have done quite reasonably well in this whole year. So yes, while on a global index, the let's take the large banks or the large cap funds have not performed. But if you look at the capital market, look at the auto sector, I think they've done reasonably well at this point of time, given a 20-25% return in an environment. So, so we need to have a perspective, and that
Yeah.
perspective is as follows. India's problem is not the war. India's problem started on if you look at 28th February, we were way down 5 years of zero FDI. And nothing tells me that, it's unfortunate, I'm a little different, to say the fact three things. One, the most important, we all blame the Iran war. But I'm quite surprised that the same amount of women who go after Trump for his talking about women in a derogatory way have not responded to say this regime was the most aggressive regime for women in the world ever existed. It should be brought down, full stop. Economic price notwithstanding. That's one. The number two is, if you look at what's happened in Maharashtra, 2 lakh farm loan waiver. If you look at what happens every election, 10,000 per person. What does it tell you? The story tells you is that the economic engine is not working enough for people to vote, and therefore I need to give, and it's all across the board, all political parties. I need to give that 2 lakh waiver. I need to do that MFI out of the place. I need to give that 10,000 rupees per month, irrespective of the economic cost. So the real story sits there in India's economy. When people say, why do FPI don't invest? The reason is clear. Why did you have to give a 2 lakh waiver? What happened suddenly in the economy that 2 lakh waiver has to be given? And what happens to the banks and FPI? So, while we can say, foreign investors are fickle, AI story, etc., we need to do our bit. Go beyond jingoism, be practical, realistic, and say, this is where economics works. This is where investors like to come. And therefore, a 5-year negative window has to change, not by giving loan waivers or by giving handouts. I think it will change by things on the ground.
Wow, Ajay really on a roll this morning, right? I mean, you've covered the whole ground from precious metals, commodities, all the way to farm loan waivers and what's happening in rural India. So let me go back and, revisit all of those, chapters one by one. And I completely take that point. Yes, I think the only place in the market where money was made was metals, whoever got that trade right and whoever kept doubling down on that trade, including metal stocks here in India. And of course, autos. I mean, ever since that GST cut was announced, autos have done really well. So on that point, now I'm talking about that 1/3 portion of your portfolio which you will still put in Indian equities for patriotic reasons or otherwise. Within that, will you still follow the same themes that were working in the last few months, which is metals and auto?
Oh, absolutely.
Or is it time to turn and look at something else?
No, not at all. Not at all. There is no need to change every year the portfolio strategy because there are long-term things building into it. Whether it is the capital market, the reason you build into capital market is because they're monopolies. You can't create an MCX overnight. Can't create an NSE overnight. BSE is catching up, and therefore it gives a better growth trajectory. But you can't create an exchange overnight and get customers to come and trade on it. Yeah, there is a third exchange coming up. We all know about it, but it'll take its time for him to come up. But two big exchanges, one big commodity exchange, these are monopolies. You really want to be there at the end of the day. And, so therefore, there's no need to change the theme. If India has to perform, if Indian equity has to perform, people need to trade. If FPIs want to come to India for whatever reason, right, they need to trade on these stock exchanges. So at the end of the day, these are the pipeline to India's economic growth, and therefore you need to invest in them. That's the first point where you can make money is capital market theme. I think it's a great theme, no need to discontinue. Mining and metal, it'll have its own vicissitude. It's not going to happen in one-way street. There will be time when aluminum will be down 20% or zinc will be down 10%. But long-term, keep building the portfolio. I'll remind you that Vedanta at one time, not long back, was 60 rupees a share. From there, it has given a dividend of over 250, 300 rupees, and still it is 700 rupees. It's a game of accumulation because these are again monopolies. You can't create a bauxite mine overnight. You can't create a zinc smelter overnight at the end of the day. It takes 10 years, 15 years. So you are sitting on an asset in India, and as rupee depreciates, the comparative product what they sell in India is zinc is globally priced, aluminum is globally priced, so you get the benefit automatically. So these are assets which nobody can create. Somebody can
But
open a department
Ajay,
store.
but Ajay, but Ajay, for the sake of argument, let me ask you: if I completely get your point, hard commodities have done really well, metals have done well, but if this war continues, and if say oil prices remain elevated, etc., people will start asking questions about global growth. And if there is a question mark or even a sentiment issue around global growth, then wouldn't metal prices correct? Wouldn't metal stocks correct? Isn't that a risk as well?
As I said, surely, as I said, the vicissitude means metal are volatile, they will correct. And that's why they keep giving you opportunities to buy. Not long back, the share was 20% down. So the idea is that when the correction happens, you accumulate. Don't panic and sell out. That's one. Number two is global growth. Ruby, I am telling you something. You travel around the world, you will see that we are, our per capita is the poorest in the world. Do you think a guy in Germany cares about global growth? Do the guy in Sweden cares about global growth? Does an average family in America care? They are well off today. They are doing really well compared to where we are today. We are more concerned about growth. I don't think they care a damn about global growth because a German guy gets his pension, lives in Thailand, buys a house in Thailand and lives there, even if he's a plumber at the end of the day. So this global growth story is, I think, overblown because of the fact that we want to push the envelope like pollution to global. Nothing is wrong. The Europe is enjoying themselves like nobody. Go to Europe, you won't find a hotel room in the summers at the end of the day, including Indians are going all over the place. But the fact is, the local population, they're taken care of. They got pension plans. You look at the Norwegian sovereign fund, can give the money to the people for next 25 years without making a single rupee. Now, that's the point. The global growth does not impact this whole white civilization and maybe the Arabs as much as to India, etc. Because we are a growing country. We have poverty here. We are 70% people who need loan waiver at the end of the day. To us, growth is more important than global growth. So I think let's not overreact on global growth may slow down. Remember this, oil at 100, somebody's paying and somebody's getting at the end of the day. Middle East is going to get the money, and what do? They go invest in the United States of America at the end of the day. So it's a zero-sum game. Somebody's gaining, somebody's losing. So global growth is not going anywhere, let me tell you. We need to focus on India at this point of time and say, we need to grow. Forget all this global growth nonsense because they are doing fine. Believe me, you travel anywhere in the world and you see the senior citizens of European countries and you wonder why you were born brown.
Oh gosh, really on fire, Ajay, huh? There are those who will argue that we're not that bad off. I mean, statistically, obviously, it'll stir up a huge debate whether 7% is really 7% or is it
2 lakh
actually 5%.
rupee loan waiver.
GDP
Should be
number.
2 lakh rupee. 2 lakh rupee loan waiver. Why does it require?
I knew you. But that's become a political instrument across party lines, right? Across states. Every time there's an election,
exactly.
Some freebie is given. That's become like a bit of a habit, which is a separate conversation. I mean, why we pick up bad habits, I don't know. But then as humans, we do. Speaking of habits, Ajay, just to come back and complete the point on Indian equities, and then I want to talk about precious metals, what you just said. But on Indian equities, so you're saying capital market stocks, that space, metals, these are things you're structurally optimistic on. If someone is hearing you right now and wants to add Indian equities from a portfolio perspective, at least for the next 1 year, what else can he or she or they, what can they consider? Some people argue, like our previous guest was arguing, that ultimately Indian IT will prevail. They will not vanish, these companies. And you have valuation comfort here. I don't know if that argument holds for you. But portfolio investors wanting to buy into this dip, what all can they look at?
First of all, I think auto ancillary space is phenomenal. India is phenomenal. We are a global players. We are the strongest player in auto business in the world. There's no need to be pessimistic about some parts of our economy. We're very good. Auto ancillaries are a fantastic place. So whether it's two-wheeler autos or auto ancillaries, I think we are in the greatest space in the world at this point of time. And we'll grow. As South America opens and if Africa opens, Middle East does well, we will grow phenomenally well. Europe, we are doing very well at this point of time. We're buying their companies, European companies. Indians are buying them out. But every day you see 1 or 2 transactions. So I think auto ancillaries is a great story out there, believe me. Some of the secular stories which keep coming up and going back and to book profits is like things like hotels, things like hospitals. But again, You need to find the comfort in valuation. We are not finding the comfort, so we are not really invested there at the point in time. Great segment, absolutely phenomenal. But valuation 70p, 80p, not our cup of tea at the end of the day. So if you ask me comfortably where I would like to put my money, I would like to put my money in auto ancillaries. I would like to put my money in CDMO companies, which are the drug manufacturer companies, because there again, you can't duplicate. Once the site is approved for manufacture, it goes on for years and the profit margins are phenomenal. It takes patience. And therefore, the CDMO companies, India's best answer to global competition. You know to worry about. You can invest. Some of them have done badly. Let me be honest about it. So you got to be careful. But the fact is, it's a great segment. Absolutely. Telecom. It's a steady earner. If you want to be very steady with your income, telecom is a great story because there's actually only one listed player in this country. Or second one is actually irrelevant to my mind. So but the story is doing well, because it's moving from telecom, it's moving to banking, or to, at this point of time, that company is moving to banking sector. So I think telecom will expand because that's a connectivity point where they can start to sell services to India. So I think there are segments apart from capital market, mining, metal, auto ancillaries. You will see, as I said, telecom will do a great job. Engineering, exports, again, exports. Engineering, export, we have phenomenal companies, absolutely. And let's not forget, when you say war, hopefully defense companies will do well, right?
And they have. I mean, relatively speaking, they're better off the rest of the lot, most of the others, at least over the last couple of weeks. Ajay, final question then. So, for every new 100 rupee that you have to invest, and this is investment for at least over 1 year, 1 to 2 year period, you think people will make more money putting that in Indian equity? Or do you think you would still put that money in gold, which has actually not rallied so much during this geopolitical conflict? It's been very range bound.
For a change, let me be the interviewer. What do you think you should be doing with your 100 rupees, Suruvi?
I actually agree with what you're saying. I think I'll spread it across. I will definitely take some gold exposure if I don't have much. But then with gold, you never know. You wait for the dip doesn't come, and then 4,000 becomes 5,000. But I agree with you. I would definitely diversify, given everything that's happening.
There we go. You already have the answer. You already know the answer before you ask for it.
Now I should go and look at my mutual funds, which I barely have. I think I should go and do my own portfolio asset allocation today.
They are singularly criminal of, if you look at the IPOs pricing, which has gone wrong, is the mutual funds issues in this country. If they had been sensible in IPOs, we wouldn't be in this situation today. We would have made tons of money. They should have been realistic where the park 20, 30,000 crores of mutual funds are parked in IPOs. I think that's a single point nagging me always is, what were they thinking when they were putting this money in the IPOs? That's the only point. Really, the old saying is, were you smoking pot? And the answer would be perhaps they were smoking lots of pot when they did these investments.
Oh gosh, I hope they're not listening, or maybe they are, and some of them I know very well, and I'm sure they'll expect a counter. Speaking of mutual funds, today the data is coming out, the monthly inflow data. Last month, investors poured in everything they had in gold and silver ETFs. Now let's see what they've done this month. But that's to speak from the MF fraternity's side, what can they do? They're flush with so much money. The whole financialization story of India. They have to park it somewhere.
You don't have to buy. So you don't have to buy a share. No. Warren Buffett sits on $360 billion of cash. I don't think there's any argument to say that, listen, I needed to put the money, therefore I parked the valuation. 4 Indian mutual funds can decide the IPO pricing in this country, Surabhi, at the end of the day. They can dictate the pricing. So if they stand firm and say, we want fair valuation for our investors, no IPO in this country can succeed, because last 2-3 years, MF have been the anchor, not the FIs. Earlier excuse was FIs are buying, so what do we do?
You're right.
In last 24 months, Indian mutual funds have been the anchor. They had a full right and the power to dictate pricing in the country, and they gave away the power in favor of investment bankers versus and the investors lost. I think that's where the gripe is. That listen, you have the firepower. You can call in the company and says, I want the share at this price. Full stop, Mr. IPO. And the guy has no choice but to give it to you. They have not used that power is the issue.
Well, packing in a punch, packing in many punches today, Ajay, as always. That's a strong argument. And it's a very valid one as well. Push and pull factors on both sides. But yes, hopefully all those decisions are being made with the investor interest and valuations kept firmly in mind at the end of the day.
So we just
Thank
one
you so
last
much.
point.
Fantastic
I must
conversation as always, Ajay. Yes.
Thank you very much. Okay.
No, go on. You were making a last point. I think Ajay just logged off over there. But he's really going no holds barred out there, talking about how he at least sees that this is the time to be diversified, not go all in on Indian equities, and make sure you have some global equities and some gold in your portfolio as well. Well, on that note, let's do one thing. We've got a very special conversation lined up with Moneycontrol Pro in the next couple of minutes. Moneycontrol Pro has been digging deep to see what the impact in terms of stock level impact and sector level impact can be because of this oil and gas disruption in the Middle East. So we'll get to our colleague Anubhav Saha in the next couple of minutes. But in the meantime, just hear out what US President Donald Trump had to say. He was, of course, making a statement earlier, and he said that the United States may consider its military campaign against Iran a success, but will continue its operations. He said that US forces are targeting Iran's drone capabilities and claimed that drone launches have fallen 83%. Listen into this very quickly, and we're back with Anubhav Sahu and the Moneycontrol Pro analysis of the specific impact on stocks and sectors because of this West Asia conflict.
We continue to target Iran's drone and missile capabilities. Their drones are way down. Their drone manufacturing has been hit starting today. We know all of the places they manufacture the drones, and they're being hit one after another. Their missile capability is down to about 10%, maybe less. But it's all resulting in a 90% decline in various things, but in particular, Iranian missile launchers, and 83% drop in drone launchers. As you know, the drone launchers are pretty well shot, but we're at over 90% decline in the Iranian missile launchers, which is very hard to reproduce and very hard to get. So now we have low-cost interceptors effectively combating Iranian drones, and our B-2 bombers recently dropped dozens of 2,000-pound bombs to destroy missile launchers all over Iran and very deep under Iranian soil in many cases. The soil was no match. And we're also annihilating the manufacturing base that the regime uses to build drones and missiles at a rate that nobody thought was possible. We're knocking them out. We know where they all are. We're knocking them out. We're ahead of our initial timeline by a lot. I would say that we probably would not have thought after a month we'd be here. In addition to the fact that we've taken out the leadership twice and maybe three times. We want to keep it that way. As we continue Operation Epic Fury, we're also focused on keeping energy and oil flowing to the world. And I will not allow a terrorist regime to hold the world hostage and attempt to stop the globe's oil supply. And if Iran does anything to do that, they'll get hit at a much, much harder level. I will take out those targets that were easy and that I mentioned just before. We'll take them out so quickly, they'll never be able to recover, ever. Disruption, the United States is offering political risk insurance to any tankers operating in the Gulf, so we're putting up risk insurance. We'll perhaps go alongside of them for protection. We don't think it'll be necessary if it is. And if they do anything, the price will be incalculable, I might add. We're also waiving certain oil-related sanctions to reduce prices. So we have sanctions on some countries. We're going to take those sanctions off till this straightens out. Then who knows, maybe we won't have to put them on. There'll be so much peace. But when the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed. I hope it's not going to be needed, but if it's needed, we'll escort them right through.
Okay, all right. Those are some remarks made by the US president earlier. But for now, what we have is that relief rally that continues through the market. The market has given up quite a bit from the top. We have to acknowledge that. This was about a 230, 240 point up move initially when the market opened up, and now it's about a 100 point up move on the Nifty. Mid-cap index has also cooled off. The gain is about 1% right now. As promised, let's go to Anubhav to get the MC Pro analysis of what this war really means for your investments, for stocks and sectors listed in the Indian market. Anubhav, thank you so much for joining in. Great to have you on.
Thanks a lot, Surabhi. And quite a crazy 2 days. I mean,
So, Anubhav,
yesterday we saw
Yeah.
price Sigma event as far as the oil market is concerned, and a bit of a relief,
Yeah.
today after Trump's tweet. Sorry, interview actually.
No, absolutely. Oh, absolutely. Anubhav, and it's anyone's guess, right, how long this lasts. So words are one thing, actions are another thing. And I think the market's not convinced about the actions. Where are those
Absolutely.
missiles still going? Where are those drones still going? This promise of a safe passage through Hormuz, we've heard this before. We heard it last week. We've heard it again last night. But, the market has to be fully convinced. So just your thoughts, opening thoughts, and then let's get to the analysis. Tell us more. What has the MC Pro team kind of pulled together on this? Because the whole issue is that India has extreme sensitivity to both oil and gas, because the bulk of our supplies are coming in through that strait, which as of now is still shut.
Right. So first of all, on Trump, the Trump geopolitics requires that how much is the walk to the talk, kind of thing. And as far as the war is concerned, it requires two to tango. So we don't know, how Iran actually responds to it, and to what extent actually they are willing to go after this. But of course, it opens up an alternative scenario. Suppose if the war ends quickly and they say, quick normalcy as far as the Strait of Hormuz is concerned, so they may also open an alternative scenario wherein in some pockets may actually see a supply glut kind of a thing. Because you remember before the war, oil market was already in surplus, and then OPEC had already announced higher production. There's more Russian supplies in the market, and then number of countries have also announced utilizing their stockpile of oil reserves. So that side scenario is also possible in some pockets, not for all. But as for the central case concerned, of course, if the war continues, conflict continues for longer, for us, as far as India is concerned, the boundary conditions are very much, clear as far as the sourcing of oil and gas is concerned. And the math is very simple as far as the oil is concerned, like around 55-60% of oil we source is from Middle East, 20% is from Russia. And given the new dynamics, probably that 20% can go to 40%, but it won't be fully, compensating if we don't get the supplies from Middle East. Same goes for gas, actually. Around 50% of our consumption is imported, and about 60% of that is actually from Middle East. And the same for LPG. Actually, LPG, the condition, the scenario is even more on an extreme side, wherein 90% of what we source is actually from Middle East. So that kind of boundary condition is there. So for us, actually, the first risk for these sectors is in terms of sourcing, how to manage the sourcing of these two, raw materials or the feedstock as maybe for the various sectors.
So, in terms of sectors, who perhaps is at greatest risk? QSRs, of course, we've seen the restaurant operators raise a red flag.
Right.
So, is it going to be city gas distribution? Is it which sector looks the most vulnerable right now?
So clearly, if you look at the events of last few days after force majeure by Qatar Energy, and thereafter the similar decision being taken by GAIL and Petronet, and so downstream industry which are dependent on both LNG and LPG, they are the most impacted because it's a case of sourcing risk. It's a case of actually continuing the operations, and in that sense, actually. Sectors like tiles, sanitary ware, which largely depend on LNG supply or propane supply, they got impacted. We have seen the notification for the LPG supply, wherein it would be preferred for domestic consumption, and that's why the commercial consumption for the restaurants would be impacted, if this conflict continues. And so in that sense, even the quick food delivery companies would also be impacted in that sense. And then a lot of this gas supply, LNG supply, is also used for industrial heating. So we have seen, some exchange filings, say from PG Electroplast, etc. Those companies that they had to cut down the operation because of that. So those will be the first one to getting impacted. Then of course there's scores of companies which are actually dependent on crude oil derivatives, right from chemicals, paint, plastic packaging, and all. So those would also be impacted. But here, granularity of the industry also comes into play, because in the downstream, it also depends on how dependent on that particular chemical that particular company or industry is, in terms of sourcing it from Middle East. So if it is not too much dependent on Middle East, so probably sourcing may not be that big a problem, but the pricing would certainly be. But there are a set of chemicals on which we are over dependent on Middle East. For example, methanol, probably even more than what we are dependent as far as the crude oil is concerned. And so the sourcing is even higher. So bunch of companies like Balaji Amines, Bodil Chemicals, those kind of companies would be impacted. But at the same time, there are a set of companies in the chemicals which are immune from, or relatively immune from, the crude oil value chain. And those would be interesting to watch, actually, because in sympathy with the sector impact, probably they may be impacted as far as the price action is concerned. But in terms of value chain, probably they are relatively immune. I mean, I'm talking about oleochemicals is one value chain to look at, where the companies like Galaxy Surfactants or Fine Organics would be relatively better off. Same goes for graphite electrode stocks, which, though they depend on petroleum-linked derivative, but they are not dependent on Middle East. So they for them, the key raw material is needle coke, and so on.
Sure. Okay, that's very, very helpful analysis, Anubhav. It gives us kind of a rough grid to work with in terms of who gets impacted to what extent. And it's important to keep that distinctions, like you mentioned. Even chemicals sector, it's a very complex sector. So there could be companies that are dealing in chemicals, but not directly petrochemicals. So maybe not that badly hit. Take that point entirely. And by the way, Anubhav, as we are winding up our discussion with you, guess what? The price of oil is back to $94 a barrel. Let's fire up Brent oil prices if we can. Yesterday, when the news first came that President Trump is talking about taking over the Strait, and he's saying that, the war will reach its logical conclusion, etc., the price had collapsed to $84 a barrel. And again, within 12 hours, it's back up to $94 a barrel. Yeah, so that is the amount of volatility in the markets right now. So it's extremely difficult. And clearly, like I'm saying, words are one thing, the market needs action.
In context, right? So we just wanted to also mention, in case, we go, I mean, if the optimistic scenario happens, the war winds up early than expected, then also there's already a lot of damage to the oil infrastructure, whether you call oil depots or refineries. So it will take time to restart. So even if there is no damage for example, a refinery typically takes 2 weeks. And for something like Qatar Energy, probably can take months to actually come back. Yeah.
Absolutely, absolutely. Of course, Mr. Trump feels it's quote unquote a small price to pay, right, for conquering Iran. So he feels it's a small price. For global markets, it's anything but small, I think. That's what the last couple of days have shown. Thank you so much, Anubhav. Good conversation as always. Very, very helpful. Thanks for joining in. And viewers, please remember, for more such analysis, for more details and more stock ideas and stock level inputs, please go on and take that subscription. Get on the Moneycontrol Pro platform for more intuitive and, of course, more detailed stock analysis. Thanks, Anubhav. You have a good day. And we'll see you again soon.
Same to you.
Thank you. All right, viewers, with that, we are going to wind down this edition of Opening Bell. Look at the market. It is slipping and slipping fast. Let's show the intraday graph of the Nifty as we wind down. The Nifty is now up just about 50 points. What started as a 1% increase on the market is down to 0.2%. You can see that downward drift. So that was always the point that I was making, that you'll get the gap up opening, you'll get the pop. Will it sustain or not? That's the question. It's a long day ahead. Maybe we'll have a second wave of buying come through. So let's wait and watch. But the market continues to be really, really volatile. The central point remains what happens to India? What about our energy security as things remain so uncertain around the Middle East? Well, as we wind up the show, I leave you with a conversation that I had yesterday with Mr. Soumyakanti Ghosh, the principal economic advisor to State Bank of India. Of course, Soumya is a very, very well-regarded economist, and he has done some very, very precise calculations on what the escalation in the price of oil means for India at a macro level, whether it's our fiscal deficit, whether it's our growth, whether it's our current account deficit. So do we really have a reason to worry right now? Watch this conversation, and we'll be with you on Moneycontrol with more updates in just a bit. Thank you. So Soumya, right there, when we agreed, when Soumya said that, yes, let's speak on Monday, at that point in time, honestly, I never thought that we'll wake up to a Monday morning and oil prices will be surging 25%. So it is an oil shock. It is the oil shock of at least our lifetime, my lifetime, because we were too young when the Gulf War was raging in 1991. How do you assess the developments and the market reaction so far, Soumya?
Yeah, no, I think Surabhi, again, thank you. I think the price jump on Saturday when it closed, I think we were looking at a price of around 93, and I think today morning the price had galloped towards 120. Now it has, I think, retreated to 106 to 107. So the first point to note is that the Strait of Hormuz, if I give you these numbers, I think around 5.5 million barrels India imports on a daily basis crude requirements. 90% of India's crude is made through imports, of which 2 billion barrel comes through the Strait of Hormuz. So basically that's quite a significant number. So out of 5.5, 2. So therefore any closing on the Strait of Hormuz is likely to have an impact on the India's imports. This is point number one. The second point to note is that if we had taken an assumptions of around $66 per barrel, which was before the war started, and now if we take an average of $90 per barrel for the month of March, I think there is already an increase of around 4 to 5 billion in India's import bill. So for this fiscal year, of course. And next year, if the average, and so basically this year already we can have an increase of at least 4 to 5 billion in the import bill, if we assuming that the March numbers are actually at 90, which looks a distinct possibility as of now. Next year, I think if this continues, I think next year it could also again push up an import bill. As of now, if we assume that the numbers may remain close to 90 to 100 or something like that, there will be an additional import burden of 10 billion, assuming that Indian oil consumption goes at the same rate at last year. So the impact is already an impact on the oil import bill. Now, the third important point is
that's
now
10 billion, Soumya. Soumya, sorry to interrupt you. I'm just going over the numbers once again for the benefit of our viewers. So you're saying in FY27, the oil import bill impact could be around $10 billion if oil continues to hover around 90.
As of today, it should be at least around 10 billion. And at least I'm talking about, and this year, I think in the month of March, the total import bill could be around excess of around 4 billion. So the overall import bill for current fiscal year, which ends on March 31st, could be at close to 4 billion. Next year, at least it could be 10 billion if the prices continue to hover around this level. And this number actually could go higher depending on Indian oil consumption. I am making very conservative estimates. So this is the first thing. The second important point to note is that I think, as I said to you, out of 5.5 billion which India imports, around 2 billion comes to Strait of Hormuz. So of course there is a disruption. The third important point to note is that I think at the beginning of the year, all of us was talking about an oil prices going towards 50, and we had actually spoken about it given the fact that the global economy could get into some sort of a slowdown. Now what has happened, the oil prices have moved beyond 100. So even if it declines from the current level, I think it is unlikely to head back to levels of 60 and 70. So the new normal actually could be around 80 to 90, assuming that the current trends hold true. So that is of course going to have some impact on the India's import bill.